Hey, so Paul Raballet here talking about 5 key components of the capital gains tax as it relates to estate planning. So capital gains tax is incurred when somebody sells an asset, and maybe the best way to go through everything is to explain these 5 key components of the capital gains tax as it relates to estate planning. The first one is the step up in basis. Let's say dad bought a share of stock years ago, $10 a share. Now it's worth $60 a share. If he sells it, there'll be $50 of capital gains subject to the capital gains tax. So there's a rule that says if dad dies, that share of stock and all of the appreciated assets get a step up in basis. The new basis will be the value on the date dad dies. So if he dies and it's worth $60, that $50 of capital gain that would have been taxed if dad would have sold the share of stock, poof, it goes away. All that appreciation goes on untaxed. So the heirs inherit the share of stock at the value at the date of dad's death, $60 a share. Let's say that's what it was worth. Can sell it, no capital gains tax. The second rule, and so the first one is a great one, step up in basis. The second one, not so good. It's the carryover in basis rule. Let's say before dad died, he gave or donated that share of stock to his daughter. Well, because he donated, before he died, he donated that share of stock. Now daughter receives the stock at a carryover basis. She gets whatever dad's basis was. It was $10. So now when daughter sells the stock, there'll be a pile of capital gains tax to pay. So oftentimes it's better to inherit appreciated assets, get the step up in basis. That's better than having someone give you appreciated assets where you get the carryover basis. The third rule is the home exclusion. When people sell their home, if they're single, then they get to exempt the first $250,000 of gain from capital gains tax. If they're married, they get to exempt the first $500,000 of gain from the capital gains tax. Note that it's not the amount of the sales proceeds that are exempt, it's the amount of gain. So if a married couple buys a house for $400,000, they can later sell it for up to $900,000 and pay no capital gains tax because they get to exempt the first $500,000 of gain. The fourth rule applies occasionally when people have maybe rental property and they're an investor in rental property. Oftentimes that rental property has appreciated significantly. If they sell it, they'll pay a pile of capital gains tax. So what they can do is when they sell it, and if they follow all of the particular 1031 like-kind exchange rules, they can reinvest the proceeds of that sale into a new piece of property and not have to pay capital gains tax on the gain that was recognized from the sale of the first piece of property. Keep in mind, very particular rules you have to follow, and really applies when you have someone who sells property and then takes the proceeds of that sale and invests it in what's called like-kind property. So be aware that it's sometimes called a 1031 exchange, sometimes it's called a like-kind exchange. Be aware that exists to help some families avoid capital gains tax. And then the fifth and final one, relatively new over the last maybe 5 to 10 years or so, it's making sure the married couple takes advantage of what's called the double step up in basis. Traditional estate planning from years ago, when the big focus was on estate tax, didn't allow families to take advantage of the double step up in basis. What that is sure, in Louisiana, as in a community property state, when the first spouse dies, all of the community property gets a step up in basis. There's an advantage to having community property over separate property. But then if you structure your estate planning program right, then everything gets a step up in basis when the surviving spouse dies. It's a double step up. So even the appreciation that occurs from when the first spouse dies to the second spouse dies, all that goes untaxed. You don't get that with the traditional estate planning documents like I leave my spouse usufruct or I leave my assets in trust for the benefit of my spouse, and it's an irrevocable trust after the first spouse dies. So be aware there is a way to really not only avoid estate tax, because very few people are subject to that anymore with a $22.4 million for married couple exemption. Now the focus is on avoiding capital gains tax and income tax. So you gotta really know what you're doing or work with somebody who really knows what they're doing to get this double step up in basis. It could save tens of thousands, hundreds of thousands, millions of dollars of capital gains tax depending upon asset values, appreciation, values of the estate, depending upon all those kinds of things. So there you have it, 5 aspects of the capital gains tax. 1, understanding extensively the step up in basis. 2, the carryover basis for donated property. 3, the exclusion of up to $250,000, $500,000 for married couples of gain on the sale of the house. You can sell property, reinvest it in like-kind property, follow the rules, you'll avoid capital gains tax. And then the double step up in basis, really important. Talk to your estate planning attorney about that. They ought to be able to help you get that straight for married couples, really saving the families lots of tax. Hope that helps. Now, you got to step up your game to get that step up. So thought you'd like that. Y'all have a great day.